Do you ever feel like the 2008 crash never actually ended? Do you feel like the economy recovered, but you didn't? If you're a millennial or Gen Z, you're not imagining it. Your wages never caught up. Your rent exploded. Your debt followed you into adulthood like a shadow, and the wealth you were promised never arrived. Because here's something you were never told. 2008 didn't break the system. 2008 became the system. Welcome to Money Heist, revealing the hidden mechanisms of money, power, and modern life. This is the story of the crash that never ended, the heist that never stopped, and the generation still paying the bill. To understand 2008, you must first understand what bankers discovered in the 1990s. You can turn debt into gold, as long as someone else holds the risk. Wall Street wasn't selling mortgages, it was selling risk. Wrapped in new names, new forms, new disguises, mortgage-backed securities, collateralized debt obligations, synthetic derivatives, subprime bundles. They were all the same thing, bad loans dressed as safe assets. The sales pitch was brilliant. Spread the risk across millions of people and it disappears. But the risk didn't disappear, it multiplied. Because once bankers realized they could sell debts, they needed more of it. And when they ran out of stable borrowers, they created unstable ones, people with no savings, no income verification, no realistic ability to pay. Approved for mortgages that would inevitably collapse. These weren't accidents, they were products, designed, packaged, rated AAA, sold worldwide, a fuse disguised as a fortune. By 2006, Wall Street had built an engine that could only move one way, forward, faster. Every part of the system rewarded acceleration. Banks were praised for volume, not judgment. Risk managers were sidelined because caution slowed production. Ratings agencies collected fees from the firms whose products they were scoring. Regulators trusted that markets would discipline themselves. And politicians, convinced that rising homeownership meant national progress, cheered the momentum from the sidelines. Quarter after quarter, the numbers looked flawless. Bonuses hit records, shareholders celebrated. To anyone on the inside, the boom didn't just feel strong, it felt inevitable. But inside the machinery, the structure was weakening. By 2007, the crack surfaced. A pair of Bear Stearns hedge funds evaporated almost overnight. Mortgage defaults spread through the system. Home prices turned downward for the first time in a decade. Banks that once projected invincibility could no longer value their own assets. Global lending slowed as institutions quietly questioned who still held the toxic paper and how much. Markets convulsed, but the deeper shock was recognition. The people running the system couldn't trace the risk anymore. No one could map the chains of derivatives. No one could calculate the real losses. The financial architecture had been assembled too fast, with too much faith in self-correction. And now, no one understood how the pieces fit together. Momentum had been mistaken for control. Leverage had been mistaken for stability. And once the chain reaction began, every hidden weakness surfaced at once. The detonation wasn't a single moment. It was the realization that the global economy had been running blind. By the fall of 2008, Washington faced a corner with no good exits. Credit markets were freezing. Banks were days, maybe hours, from shutting down. A global system that relied on constant movement was grinding to a halt. Policymakers made a decision that reshaped the century, stabilized the structure by supporting its most fragile pillars. Emergency lending windows opened overnight. Investment banks were merged under pressure. Failing institutions received life support under the language of stabilization. Interest rates were pushed to zero. Then came the intervention that rewired everything, quantitative easing. It sounded technical, it's almost harmless. But the goal was precise: inflate financial assets directly, push liquidity into markets, drive bond yields down, force investors into riskier assets, lift the value of stocks, real estate, and corporate debt until panic subsided. The reasoning was simple. Higher asset prices would restore confidence and stop the collapse. The consequences were not simple. When the Fed expanded the money supply, the gains filtered upward. Liquidity flowed through markets, not households. Equity values climbed, real estate rose, private equity expanded, corporate profits recovered. Everything tied to ownership gained strength. Everything tied to wages lagged behind. This became the turning point, not because authorities failed, but because the rescue cemented a structural imbalance. The recovery rebuilt the asset-owning class, and the cost of that recovery settled on everyone else. 2008 didn't conclude the crisis. It rearranged its pressure points downward onto households that never received a bailout. The crash didn't end. Its aftershocks became the foundation of modern American life. The years after the 2008 crash were labeled a recovery, but for anyone under 45, it never felt like one. What emerged wasn't a restored economy. It was an entirely different operating system, and its architecture revolved around a single principle: the financial sector could never be allowed to fail again. Once that became policy, everything downstream adjusted itself. Banks, corporations, governments, all of them reorganized around the same gravitational center. Asset prices had to rise, and that shift is where the generational break really happened. 1. Work stopped being the path upward. Before 2008, wages and productivity still moved in the same direction. More work meant more income, more savings, more stability. That link dissolved quietly after the crisis. Corporations discovered they could lift their value far more reliably by optimizing balance sheets instead of payrolls. Share buybacks replaced expansions. Efficiency replaced investment in people. Work didn't lose meaning, but its relationship to economic mobility changed. In the new system, labor could support the economy, but it could no longer propel households forward. The engine of prosperity moved elsewhere. 2. Debt became the price of admission. When interest rates fell to zero, borrowing became the primary tool for anyone who already had assets. Corporations borrowed cheaply to grow portfolios. Established homeowners leveraged their equity to acquire more property. Investors expanded into markets that once belonged to families. Younger generations borrowed too, but the structure was different. Their debt paid for essentials: education, transportation, medical bills, obligations that accumulate interest without accumulating value. Two generations used the same credit system, yet moved in opposite financial directions. The system rewarded whoever began the race with collateral and burdened anyone who started without it. 3. Housing transformed from shelter into an investment chassis. After 2008, real estate was reinterpreted. Homes became vehicles for cash flow, leverage, tax shielding, and long-term appreciation. Institutional investors recognized this faster than anyone. When they entered residential markets, prices shifted away from what families could afford and toward what capital could extract. Rents adjusted to investor expectations, starter homes became portfolio assets, neighborhoods turned into financial products. This wasn't a collapse of opportunity, it was a reclassification of property. And for millennials and Gen Z, the traditional path into stability disappeared, not because they failed to reach it, but because the destination itself had been rewritten. Anyone born after 1980 didn't inherit a malfunctioning system. They entered adulthood in a landscape already drifting toward capital-driven prosperity. The rules, incentives, and rewards had been realigned long before they arrived. The shift wasn't loud or dramatic, it happened gradually. One policy, one bailout, one rate cut at a time. A new economy emerged, one where ownership generates stability and participation requires leverage. And for younger generations, adulthood arrived with an uncomfortable truth. The economy they entered was forged in the fire of 2008, and it never returned to what came before. The real crash wasn't the week the markets fell. It was the world that took shape afterward. Once the panic passed, policymakers rebuilt the economy around a single priority: keep asset prices stable at any cost. The tools they used were new, the scale unprecedented, and the effect subtle at first. But as the years stretched on, something fundamental shifted. Markets became the center of gravity, and everything else bent around them. In a system calibrated this way, wealth doesn't rise from wages or innovation. It rises from ownership. Credit becomes the oxygen. Debt becomes the scaffolding, and everyday life becomes dependent on financial conditions far outside anyone's control. People kept working, harder than ever, but the structure beneath them was already tilting. The path their parents walked no longer led to the same places. Homes turned into financial infrastructure. Education became a liability. Healthcare evolved into an industry that priced itself upward because the system rewarded anything that inflated an asset. This is the part most people feel long before they understand it. The economy didn't recover. It reorganized. Once rising asset values became the foundation of stability, the pressure spread everywhere. Corporations prioritized balance sheets over payrolls. Investors accumulated more leverage. Local governments tied their budgets to real estate valuations. Households took on debt just to maintain the basics of a middle-class life. And slowly, without announcement or debate, the daily economy, the one lived through rent, bills, wages, and savings, fell in line beneath the financial one. That's why the world never snapped back to what it was. It wasn't supposed to. The system that emerged after 2008 runs on different rules, and younger generations entered adulthood exactly as those rules were hardening into place. They aren't navigating the shadow of a past crisis. They're living inside the architecture built after it. And until that architecture is understood, the same forces that shaped the last 15 years will keep shaping the next 15, not in headlines, but in the quiet, constant pressure underneath daily life. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.